just so everyone knows. First and foremost, welcome to our Four Oaks family. I think I know most of you, but for those of you guys that I don't know, my name's Eric Shirley. I'm the Director of Acquisitions here at Four Oaks. So kind of my role is to take properties from the time they come across my desk from a broker through the underwriting process. I work with Brian Briscoe. I'm our Director of Operations on the due diligence, and we take it all the way through closing. And then Brian takes over at that point and handles the management of the property managers, so the operating side. At Four Oaks, there's 4 of us. Only 3 could make the call tonight. There was kind of an emergency. One of our members had to step out for a bit. But it's myself, Brian Briscoe. Say hello, Brian.
Hey guys, I think I know most people on the call already, but hey, great to see y'all. And James, it's been a long time, about 22 hours maybe. Good to see you. Good to see everybody else.
Yeah, thanks for having me, man.
James must be part of that notorious Tuesday night meetup.
Oh, yeah.
He's the director of the Tuesday night meetup.
Oh, nice.
So, yep, he is. And shout out to Julie as well. I see her on her iPhone. Don't know if she can talk back, but thanks for joining us as well.
Thanks, Julie. And then we have Brian Mallon. You want to say hello, Brian?
Hello.
So Brian handles a lot of our investor relations as well as all of our media, marketing, and advertising. He's kind of, we give him raw data that's not pretty at all, and he makes it look nice to be able to send out our monthly reports on the properties that we have, any kind of future opportunities that we have, any of the videos and our social media. Kind of Brian's the brains behind all of that and the wheel that keeps this machine going. So what we're going to do tonight is we're going to go through some underwriting. There's really kind of 4 different methods of underwriting the way we do it. So when we receive an OM, we start off with the 10-minute offer, really a very high-level look to see if the price is anywhere reasonable to what we can pay. And if we're significantly off from what the asking or the whisper price is, we'll pass right out of the gate. From there, we'll do a little bit deeper dive, sharpen our pencils, assuming it does pass that test. But in that first kind of deeper dive, we're still making some large assumptions before we reach out to property management, and really kind of sharpen our pencil for that 3rd version. And then our 4th version comes after we've walked the property and can really fine tune our numbers based on feedback from our contractors, anyone doing work to the property, conversations we've had with town officials, when we call the tax assessor's office to dial in and really fine tune our tax assessment. So what we're going to go through tonight is that version 2. It's going to be that first version after we make a decision at a high level that this is a property worth at least looking at deeper. And that's what we're going to go through tonight. Guys, this is going to be a super informal version. Don't feel the need to wait till the end to ask questions. If you see something that you want to find out a little bit more about, stop me and we'll take a look at it right then and there. All of our underwriting, I do the first pass at it, and then I send it over to Brian Briscoe. He has multiple degrees in mathematics. So it's always nice to have someone double checking your work and providing a second opinion. And so Brian's going to be talking about this with me as well. And the property that we're going to go through tonight is near and dear to our hearts because this is actually the property that brought Mr. Briscoe and I together.
Yeah, so, this is one I've told this story, at least 100 times. We have a forum through the Michael Blanc program where you can post your underwriting, other people can feed back. And I still remember the day where I opened up a spreadsheet posted by a guy named Eric Shirley, and I'm like, opened it up, I looked at that, scratched my head a little bit and said, that's the same one that I'm getting ready to put an offer in right now. So long story short, picked up the phone and called him. And after about a 5-minute conversation, we decided to try to partner on that one. So
the rest
that was about a year ago. So, yeah.
So with that said, we're going to open up. I'm going to share my screen here. And welcome to Tanglewood Apartments. Can everyone see this all right? All right. So the first thing we do when we get an OM is we run through it and look for anything that jumps out, any key metrics right off the top of our head. Like most properties these days, a listing price is rarely included. but we know these brokers pretty well now. And we found out early on that the whisper on this one was 6.5. And that'll come into effect in a few minutes when we get to our SDA. So Tanglewood Apartments, it's in Columbia. For those of you that aren't familiar with Columbia, Columbia has a much larger tax rate than a lot of the other states or counties, even in South Carolina, but the other states in the Southeast. So traditionally, when we look at expenses at a high level, a lot of people say underwrite at a 50% expense ratio. Columbia, you really need to be closer to 60% to be accurate. And as the property gets stabilized and you're maximizing efficiencies, you can get it down in that 55 to 58 range. But if you're underwriting at anything below 60% expenses on the front end, you're going to be in for a rude awakening once acquisition occurs. You can see it's a great looking property. It's located right in the northeast part of Columbia. It's really a good spot, and we'll go through some of the demographics in a minute. So get into the investment highlights. It's 104 units. Effective rent is $721. We were sent the OM as well as T12 and rent roll, and the rent roll does come in right around $721 a unit, so that is accurate. 1972 vintage. It's on a nice chunk of land. It's nicely amenitized. Has a swimming pool, fitness center, clubhouse, playground, round-the-clock maintenance, and some nice landscaping. It does need a little love. I like how they call it mature landscaping. Little lipstick on a pig there, but it's a really nice property all in all. It's got nice bones.
Yeah, and one point here is a lot of brokers are going to try to oversell it in the OM. This was done by Furman Capital Partners. They're the ones that brokered the Spartanburg deal for us, and they're pretty honest brokers when it comes to the OMs, which is something I very much appreciate with them. But one thing I've definitely learned, never trust the OM.
Exactly.
So the part he threw in a very key piece. He said, I checked the rent roll and the OM's pretty solid, pretty square on.
It's close enough that I feel comfortable moving forward with the OM for my initial underwriting. And just to give a quick glance at the rent roll, we basically put it into a Excel spreadsheet, sort it by 1s, 2s, and 3s, and then just let we use our let Excel do what it does. It's going to do the math down here for us, and it confirmed our assumptions there. So it's really a quick piece just to make sure that the numbers are accurate. So 104 units, 72 vintage. They've acquired the property in 2016, so it's still fairly new to them. There's 36 upgraded units, which is going to leave 68 that still need work. Based on this, and again, this was confirmed with property management and a secondary third-party property management, but there is room to push rents between $100 and $150 a door once the units are upgraded. So you can see Columbia is the central hub of South Carolina. It's got great interstate access. It's the state capital. It's got a large university. It's got a lot of government. It's got multiple healthcare systems. So it's a very diverse economic population, which makes it a really strong market. The biggest downside is the taxation. This is just kind of an overview on Columbia. You can see vacancy continues to drop. Rents continue to rise. It's certainly something that we want to see. We had already done our market analysis on this MSA. So we already knew Columbia was an area that we'd identified as fruitful, but this just further confirms that. You can see, again, everything's moving in the direction that we wanted to move. Unemployment's dropping, continues to drop. We got some more information on that today. Huge military base. Fort Jackson is a huge Army base in Columbia. So I don't want to bore you with this kind of stuff, but we do look at all this. You can see its proximity to other apartments, which is really good because it allows us to come in with really strong comps on what we think we're going to be able to push rents to and have a really strong opinion on our ability to execute our business plan based on those numbers. Demographics, you can see the units need a little bit of love, that great old brown carpet, unupgraded kitchens. Nice square footage. One bedrooms are 875. The twos are 1175. So it's a really nice. Threes are 1300. And you can see the breakdown right here. These are the asking rents. These are not the current rent rolls. We've got comps here. You can see price per square. And some of these, Hunt Club Village just went on the market. So we know some of these other properties, and we'll get into some of that on the SDA. But sale comps, and then the financials. So I don't want to bore you guys with this stuff. I know some of you guys are pretty familiar with this. Some other folks might not be as familiar. Like Brian mentioned, their T12 numbers are spot on with the T12. There's no hidden things. One of the things,
Eric,
yes.
Can you back up to the sales comp, the map? Let me point something out. This is something you got to be careful on. All right, look at where the subject property is, and look where all the comps were. Okay.
Yeah.
On the rent comp page, it was everything next door. On the sale comp page, you're looking at all the way on the other side of Columbia. All right. For the most part, Furman Capital or Honest Brokers, this is probably the only case where when I went through this, I looked at, I'm like, are those real sale comps? You know, if you're 15 miles away on the other side of the city, are those real sale comps? So when you're going through these, you know, this is part of the reason why we have two eyes on this every time is, you know, I catch stuff that Eric doesn't, and Eric catches a lot of stuff that I don't. This was something that first time through, you know, looked at the map, looked at the dots, and like, you know, we were looking at a place in St. Andrews, which is to the left side of the center of the screen, same week, that was at $40K a door, you know. So anyway, not really comparable, but you just got to be able to sift through that sometimes.
And at their 6.5 whisper, that puts it at about 62.5 a door, which based on these comps that were selectively picked, makes it look like it's a really good bargain. But if, like Brian said, when you really dive into the sales comps, and one of the things we always like to request is a CoStar, because CoStar is going to give you a lot more information. The brokers can pick and choose what they put in an OM. They can't hide what's put in the CoStar. All right, so so here's the financials. They put in a T12, a T3 with T12 expenses. T3, this is what a lot of times the lender will look at when they're going to give you a term sheet. So it's nice that they included that in this OM. This is their pro forma, which ironically enough, similar to what Brian said earlier, this pro forma is very similar to the pro forma we got from a third-party management company. And then it spreads it out years 2 through 5 to kind of show us what the long-term upside is on this property. So we're going to dive into the SDA now. Does anyone have any questions up to this point?
No, does everybody on the call know what an SDA is? I don't know if everybody's a Michael Blanc affiliate.
Okay, so the SDA is essentially our underwriting software. It's a glorified Excel spreadsheet that is extremely robust.
Mm-hmm.
So we're going to start at the top. We know our asking price is 6.5. We're going to plug that in. Number of units we know is 104. So one of the first things we do as soon as we find a property that we like, one of the first calls we make is to our lender. And so I called our lender, who's Scott at Align Capital, and we are able in this MSA with a property of this size, we would theoretically be able to get 20% LTV, which is loan to value for those of you that don't know, as far as our financing and our debt service. So we'll change this to 20%. Repairs and reserves. We know that there's 68, and I always do this over here to the side. There's 68 unrenovated units. They're going to cost, let's pencil in just as an assumption, let's say $5,000 a door. So we know right out of the gate, just to get those units up to par, we're looking at $340,000. That doesn't include any reserves or any exterior CapEx. So we'll put in about another $100,000 in exterior CapEx. And then we'll put in for repairs and reserves. We typically use 1 month operating expenses, and we'll get to that momentarily when we get into our expenses. Or you can do $1,000 a door, either way.
Mm-hmm.
So we'll come over here, we'll go back to our OM. We'll go up to the breakdown. So 2864.12. $28.64.12. Current average rents. We're actually, as opposed to, because this is the asking rents. This is not the actual rents. You got to be really careful with that. Because if you go out the asking rent, you're going to be paying future value of the property as opposed to today's value of the property. So we're going to go to the rent roll. We're going to take a look at we're going to come all the way over. So we'll start with 2 bedrooms because we're up here. So we're going to stop right here only because this, you can see this is double marked. So just one's occupied. When they renew, they're going to raise the rent. But for now, we're going to pick up right there where it left off. We're going to do the same thing right here. And that puts us through all of our 2 bedrooms. So let me move you guys can't see my box right here. So it puts us at 739 on average. So we'll come over here and plug that in. Is this what Mark, I assume this is you guys are doing the same?
I'm sorry, what was that?
I assume you guys do very similar.
Yeah, absolutely. I created a different, my own tab for that because I have a bunch of other stuff going on like renos and all that stuff.
And we do that when we get in our further versions.
Okay.
As well.
Yeah, our first version is rough, and every time we're asking ourselves, is this a good enough deal to put more time and effort into? So once we go through the original set of materials, looking straight off of the T12, if it looks like it's a good deal, we're going to start refining. We're going to sharpen our pencil, and we're going to get closer and closer and closer.
Yep.
To the point to where, in several cases, when we're looking at comps, we actually walk into the comps and pretend we're renters. But anyway.
So once we get these basic fundamental numbers in, we know, and again, I confirmed this with PM, but for the sake of this, they said between $100 and $150 a door based on comps in improvements. So we're just going to go in and we're going to basically raise it to the easiest round number. So over here, we'll take this up to 750. Take this one up to 850. I'll take this one up to 950. So these are good starting marks to make our assumptions that we can further confirm down the line as we get more serious about the product. So now what we're going to do is we're going to take our monthly income, multiply it by 12. That's going to be 904,128.
And I know there's a couple people who aren't familiar with the SDA, but that little box in the top right is just to help you figure out what your monthly rents and your annual rents are going to be. There's one side for what the current value is and one side for like a post renovation or your target later on is.
Correct. Yeah. And we know from a vacancy standpoint, from the rent roll, that there are 1, 2, 3. Actually, there's only 2. So this one's pending renewal. So that's current. This one's vacant currently, although there's an applicant and it's leased. And that's pending renewal. So as of right now, this thing has 1 vacant unit. So we're going to come in here and we'll do, based on this, it's 2% vacancy. We know based on the page down, on the financials, they're factoring in 4.5. So I'm going to go with the T12 on what they say. So we'll change that to 4.5. They're doing right at 3% concessions, but we want our number to equal that 768. So we're going to come in at 3.18 for bad debt and concessions. And then
Yeah,
other
and
income.
while he's working on vacancy, something that's very common in the Carolinas is a very high occupancy. You know, right now it's not uncommon to see, like this is at 99%. It's not uncommon to see rent rolls with every single unit filled in the Carolinas right now, which is a really good thing. And another caveat to that is if they're below market rents, the occupancy is going to be artificially higher than the market rate. So if you're going to go in with a plan to raise rents, you also need to plan for slightly higher vacancy rates because it's going to take a little longer to turn. And end of the day, you know, you're going to make more money with higher rents and a slightly higher vacancy rate than you do with lower rents and lower vacancies.
Yep. So basically all I'm doing is copying what they have over here over to my SDA. So taxes are 127,275, which we know are going to go up. 127,275. I took this other income directly off the OM. Insurance. Let's see. Insurance is 26,941. Again, I don't want to bore you guys with this stuff, but everyone's on different levels, so I want to show just kind of how we break certain things out. If you look at contract services, and we'll get into this on the T12, their contract services, everyone's contract services can include different things. Some folks include landscaping in their contract services and trash pickup. Other folks don't. It just depends what you consider your contract services and making sure you're consistent across the board. So contract services are 28,742.
And as we refine our product here, we're definitely asking the broker, you know, hey, what's included in contract services? If it's not called out on the T12, a lot of times the T12 will have separate lines for each individual entry. And if it's not, you ask the question, hey, what do they count in contract services? Just to make sure that you're accounting for things. Another trick that brokers do, I'd like to think it's inadvertently, but I don't think it is. But sometimes they'll leave out certain expenses on the OM. You know, you pull up the T12 and you see all the expenses on the T12, and you compare it to the OM, and it's like, hey, you're missing a couple of line items here. So you definitely have to be careful when you're walking through these things and make sure that the T12, you know, go off the T12 more than you go off the OM. But it's helpful to do both when you're underwriting.
And one of the things that jumps out right away is they don't put any reserves in their numbers, which is pretty significant when you're looking at a 100+ unit deal and you start factoring in, that's another 25 grand. That's at a 7 cap, you're looking at $400,000, right? $300,000. So that's a pretty significant chunk of change for them to leave out.
Yeah, and our standard for reserves is 250 per unit per year. And that's to replace, you know, big things like your air conditioners and your roofs and things like that. It's not something that you always have every single year. You know, you replace your roof every 20 to 30 years. And if you're not putting, you know, a little bit in reserve every year, you know, when it comes time to replace that roof, you're gonna have problems. So yeah, the bottom line on this one, our expense line is always the deposit to replacement and reserves.
69,778. 69,778. 69,778. All right, so that's all of our 581, 283. Let's see, 581. So we're pretty darn close here. And again, for the sake of time, we'll roll with this. So there's certain aspects of this that, again, we're going to break down when we get into the T12. Some of these numbers right off the bat, I look at it and I'm like, that seems high. Utilities, right? They lumped everything into utilities. When you look deeper, they actually have a cable contract that's included in the utilities. Now, they are currently billing back for both water as well as they do 25 a month for water. I'll show you here. 25 a month for water and sewer and 45 a month for cable with this cable contract. We would prefer for the tenants to pay for all their own utilities whenever possible. so that we can raise the rents to be competitive with the other rents, as opposed to bundling more things in. And then it just skews numbers. Because think about if you're a tenant and you look, and even though you know water and cable are included, and you look at your rent and it says, I don't know, $900, and you're looking at other properties where that isn't the case, that say $775. Which one are you going to rule out very quickly? So it really helps with the marketing if you can leave the tenant to pay as many utilities as possible. And so our goal with this right out of the gate is we know we want to keep the bill back on the water and sewer because it's not individually metered, but we would like to get rid of that cable contract as soon as humanly possible to send that back to the tenants.
Now, the state of South Carolina is very liberal in what we can do. It's a landlord-friendly state, so it allows us to charge the tenants for utilities that are centrally metered.
Correct.
Other states don't do that. I know Maryland, where I live, doesn't. North Carolina doesn't either. But it's something that is definitely state by state. So it's also helpful to know each state's laws. The one caveat to their law is we can't make a profit off of the bill back. So if you're looking at their monthly water bill, $25 a unit, that's not going to cover the entire water bill that we get. And we try to walk the line where it's close, but we can't make money, and we want to be far enough under that doesn't raise any eyebrows.
Yep. So just looking at this real fast, I've seen the T12. The T12 is exactly what's in the OM as far as financials. So we're going to use their word here. The two things I'm going to change on my version is I'm going to add in deposit to reserves, right? That's something that they left out. I'm going to factor in the tax changes. So knowing this market and knowing what the taxes are going to run, it's going to be, give or take, this would be around 155, 160. So I'm going to highball it at 160 based on this purchase price. And there's a thing called ATI. James and Mark, I can see both of you guys. Are you guys familiar with ATI? So
No, I'm not.
So ATI is essentially, South Carolina is a point of sale state. So theoretically, the taxes would change at the time of closing based on the new purchase price. Well, if the taxes are going to go up $100,000 a year, that's going to crush my numbers years 1 and 2. So what they allow for is what's called an ATI. And it's complicated to explain, but basically they look at the current taxation, or they look at if you take 25% of the new taxable value and whichever one's higher. So basically that's what the state does. So it allows you to take a little reprieve until they do a reevaluation on the taxes, which is every 5 years. Does that make sense?
They also have something similar to Maryland. They have a homestead exemption tax, which, since we're buying this as investors, that's why the taxes are so high, is they actually write into how they do the taxes where they're, if you're not an owner occupant, you're paying a much higher percentage.
Correct.
So, fortunately, if you're going to live down there and, buy a single family house, you're not paying, set that outrageous price right there. So,
yep.
Have you guys, just a quick question. Have you guys asked the, I guess the assessor's office to provide, like, what are my taxes going to be if I purchase this at this price? Do they provide that for you?
They do, and a lot of these counties actually have a calculator that you can plug in the purchase price, and it will tell you what the taxes would be.
Mm-hmm. Okay.
But yes, we always 100% of the time call to confirm. That can
Furman Capital actually has a spreadsheet that has each county on the bottom is a tab they've given to us, to help us, do it ourselves. But and their spreadsheet's fairly accurate. It's doesn't take all the complexities in, but it's going to give you a ballpark figure, which at this level, that's all we're looking for is a ballpark figure. It's definitely not at this point that we're calling the county assessor. Right now, we're just spitballing it, seeing how things look, and then we'll keep on refining the numbers as we go on.
So what I'm going to do next, just real fast, is so the marketing package, this is exactly what we saw in the marketing package. My version, I took the exact numbers from the marketing package. I changed the taxes to what I know roughly they're going to go up to. and I added in the deposits to replacement reserves, that jumped our expenses up to 68%. So this thing's operating at a very high level of expenses, which tells me right away that we can implement some operational efficiencies to bring those down to where they should be, which is going to help make this a true value add. One of the other things I'm going to do next is I'm going to plug in my repairs and reserves. So we came up with this number by 5,000 times the amount of unrenovated units, 100,000 for general CapEx on the exterior. Again, all this can be fine-tuned and revised with the property tour. And then replacement reserves, we call it our oh crap fund, because there's always something you don't expect to happen that's going to happen. So right there, we're looking at 544,000. So we'll plug that in. All right. Term sheet. Let's go back when we were looking at this, rates were a lot more favorable, but we'll go 4.7 30-year AM. All right. Any questions on any of this stuff on the first two columns? All right. The next thing I'm going to enter in is I'm going to take what my target at target rent, take that number, multiply it by 12 months. What happened there? Oh, sorry. Take this number, multiply by 12 months. It's going to give me 1,041,000. Right. And so this is what I know this property, what I think this property can do. And then we'll get to the offer. I always just start the offer with what they're currently asking and with all the current information, and we can tweak it from there. All right, so you can see this matches up with my version perfectly. Any questions on any of that? We use this primarily as a scratch pad, just to make sure that it populates all of our stuff on this side. We'll go into the summary tab real fast. We know that the cap rates in this market are around 6%. So 6.5 cap at resale is reasonable. Drop this down to 2%. We do an 80-20 split. We do a 2% asset management fee and no capital transaction fee. I know I went through all that really fast, but any questions on any of that?
Yeah, and a lot of the summary tab is just, you know, how we're going to structure the deal. So, you know, one thing he threw in there was the member split versus the management. So the general partnership versus the limited partnership. I think you said 80-20 on this one, right?
Correct.
So the investors collectively would have 80% of the ownership of this, and you know the management team will get 20%. And that's kind of how we pay ourselves for doing all the work. The nice part for the limited partners or the investors is they sit back and they get their mailbox checks.
Exactly.
Yeah, we're going to put a lot of work into this.
So then we go over to our first mortgage. We know it's pretty common nowadays to be able to get 3 years of IO. So we're looking at basically a 4.7% rate, 30-year AM, 80% LTV with 3 years IO. All right, now we're going to come over to our P&L and we're going to chop away a couple things real fast. We always start at 2% to be conservative, and then we can always bring it up if we feel the market demands higher. But we like to underwrite conservatively. So I use scenario 4, so that's going to pre-populate on my P&L. We're going to go back to our scenarios tab. We know ultimately that we're going to try to raise rents to $835 on average. So come back to our P&L, and we know that's where we want it to be. We like to do things gradually, so we're going to try to do roughly 40% of the improvements year 1, 40% of the improvements year 2, and the final 20% in year 3. So we feel confident that we can hit that number by the end of year 3, if not higher. 724 is where we are today. So we know year 1, we're going to be able to make some tweaks and raise rents a little bit. So we'll bring that up to 750. We want to get to 835, so we'll split the difference. So 750, that's $85. We'll call it 45 here. Nope, 795. and at least 40 in the final year. Any questions on that? We're pretty comfortable with the 7.5, almost 8% overall vacancy and bad debt mark. That's not unreasonable, especially considering this property is currently has one vacant unit out of 104, so it's operating at over 99% occupancy. And we're not doing anything crazy to push rents, so we feel pretty confident with the right property management team that we can continue to maintain a very high level of occupancy.
And realistically, we're not going to, I mean, this is 104 units. The property management's not going to have the bandwidth to do a full-on renovation. So we're probably going to be doing 3 or 4 units at a time, you know, maybe not a whole lot more. So even with the 3 to 4 units being renovated, we're still underneath the 5% vacancy rate, which is something that we can definitely handle. Now, depending on the units, you know, the unit count and how fast the renovation schedule is, you know, we may dial that vacancy up a little bit. Yeah, in this one, I think he's spot on, you know, with the sub-market hitting like a 98, 99% occupancy rate, we're safe at a 7% total, almost 8.
Yeah. So when I look at my first year P&L, I'm going to change a couple things on this as we start to fine tune things. We know that there's a cable contract. I know from the other slide, and just for the sake of time, the cable contract's $52,000 a year. So we're going to subtract $52,000 out of this line item, which is going to put us at $61,334. All right. And these are just things, again, this is the first version of sharpening the pencil. We'll get much tighter on numbers with future versions. We just want to see where this thing's going to come in at, to see realistically where we'd be able to come in at an offer to be competitive, right? This R&M budget is way too small, 7%. We really want to be, for 1970s vintage, we do really want to be around that 10% mark. So we want to be around 97,000. General and admin, this number combined with our advertising budget is way too high. You can see we're currently at that 63%. We know as our operational efficiencies improve, we're going to be able to trim some fat and get this around the 60 mark, if not under. 55 is a really high functioning property. So we're going to trim this down to 50. And again, we'll fine tune some of this stuff. But this gets us to a place where I feel really strongly about at least an initial P&L with our numbers that we can be comfortable with on our end to be able to propose to our investors as we, you know, a good starting point to sharpen our pencils. 62% expenses year one. And by the time we get to a fine-tuned point, we're in that high 50% range. Any questions on any of that?
Yeah, Eric.
Yes.
You removed the expense of the cable contract, right?
Correct.
Were they were getting income from the contract?
Correct.
You take that out? I didn't see that, but.
Yep, great question. Theoretically, yes. But what we do know, and again, I'm skipping all around here. So the water bill averages around $58 a door per month. So basically the money that they were paying towards cable on a monthly basis, we'll continue to charge that amount, but we'll deem it
Shift it. Yeah.
Okay.
Yeah, this one had a higher than normal water bill. I mean, the water average in the area, and once again, you know, if I remember right, the water bill was like $90,000 a year for 100 units, which is abnormally high. They have a pool, but that doesn't quite cover a $90,000 water bill. So, you know, going into this, we kind of knew the water bill was higher than anticipated. So that was something that we had earmarked to look at during due diligence. You know, why is the water high? You know, do we need to put low flow toilets in? Do we need to, you know, are there leaks somewhere? You know, so definitely something that warrants further looking once we sharpen the pencil.
Yeah. So what we did is we rolled trash into trash is rolled into contract services, right? We've still got our water and electric, so we're going to bump that back up to 96, and we took out the $43,000 cable bill, which is going to roll towards the water, like Brian alluded to. So those need to be at 96.6. So we'll keep this at 96.6. Well, we'll just put it at 80, and then 16. We'll start breaking it down. All right, so you can see our expenses are still high. This general and admin, and we go to the T12 and look at what's on the general admin, they factored in their management fees into the general admin. And so we're just moving things around based on their numbers. So we know payroll is its own line. To 54,000 for general and admin and legal. Advertising is its own line. So this number for general admin is way too high because we've already have our management fee up here. Does that make sense? So we can slash this pretty significantly. Oh, one too many zeros. So one of the other things that helps is we have really strong property management relationships throughout our target markets. So this is actually a pro forma that was sent to us from, this is the actual pro forma sent to us for year one. So it tells us what they feel like based on their experience. They actually manage several other properties that are similar size and similar vintage in Columbia. What they think they can do with the expenses. It breaks everything down. So total expenses, 559, 953. And so we're still high over here.
Yeah, and just a word on the property managers. They're probably the single most important partner that we have in the deal, because they're managing the day-to-day of everything that's going on at the property. So, you know, we go to a fair amount of effort to vet these guys. You know, make sure we're getting references and just checking up to just to verify that they are as good as they say they are. Everybody's going to say they do a good job, but and then on the flip side, you know, they make more money if we make more money. So we have to make sure that the structure works out well too. And most property managers will take a percentage of the income, which works for them, works for us, because the harder they work for us in driving that income up, the more money they make. So anyway, just point there for what it's worth.
Yeah, and we would not typically reach out to the property management when we were first getting started until we were further along in the process. Because to be quite honest, we would be wasting their time and it would be a bad way to start our relationship with them. So for the sake of this exercise, we're going to go through, and this is essentially kind of where we were when Brian and I first came across this deal.
Yeah.
So we go back to our summary. How's our exit strategy? Year 6. And based on our summary, the numbers are not super robust right now, right? So we're going to go back to our scenarios tab. We know at 62.5, that's what they want. Brian and I looked at a property right down the street what was Colony East, 45?
We were going to offer 40. We were offering 3.944 million for a 104 as well. So it was like 39 a door.
So
it wasn't in as nice of a condition for everybody, but you know, it was 39,000 a door when they were asking 62,000 per unit at this one. So, you know, compare apples and apples. You know, smaller apples to bigger apples, I guess in this case. One other thing about this property that the brokers told us was the owner was looking at refinancing. You know, so he put a line in the sand and said, "I'm going to put it on the market," and he really had kind of a pie in the sky idea of what this was worth. You know, he's going to put it on. His idea was, "I'm going to put it on the market. I've owned it for 2 years. You know, market's going really well. Prices have gone up a bit. You know, rents have gone up. I'm going to see what I can get out of it." So drew a line in the sand on the calendar and said, if I don't get the offer that I want by this day, I'll just refinance and keep the property. So something else on here, the owner, we had a deadline that we needed to get this in by, and we kind of knew what they were looking at. So that really kind of drove us at, okay, where, can we get to the price that he wants us to get at? And as we were sharpening our pencil, we were trying to basically justify paying a little bit more for this every time. So right now, what's the price you had in there right now? 5.5?
5.2.
Okay.
It's still under a 6 cap.
Yep. So 5.2 is where we thought it would work. And I think we were up to like a 5. Once we sharpened the pencil and started verifying line items, we got up to like 5.8, 5.9 on this one. And it was really tough to even hit that $6 million ceiling on this particular asset.
And they were unwilling to budge below 60 a door.
Yeah.
So again, this is a perfect example of someone they were looking to refi. They had a number that if they could get that pie in the sky number, they'd sell. If not, they were going to refi, cash out refi, and take it to the bank. But so at this point, what we would do is we would literally take a snapshot of our version column or our offer column, and then we would take a snapshot of our P&L, and we would send that to the broker and say, hey, Mr. Broker, I totally appreciate where you're coming from, and I see why, your seller, it's a great property. I see why your seller thinks so highly of it. But at the end of the day, using your numbers and plugging in the things that were left out, like the increase in taxes, as well as the deposit to replacement reserves, we feel that similar properties, and based on the comps you provided, similar properties traded around a 6 cap. We think that's a great number, and we're very comfortable with that 6 cap mark. That's going to put our number closer to the $5 million mark. I know we're really far off, and we certainly don't want to offend anyone. What are we missing?
Yeah.
And we say just like that.
Yeah, and that's a great way. It's non-offensive to the broker. I'm a Marine. I tend to be offensive, and that's why Eric handles the broker relations. But basically, it's just negotiation. And one point is the broker only gets paid if they're selling stuff. All right. If they don't close on this, they don't get a paycheck. So a lot of times we will put this in the broker's lap and say, here's what we're willing to pay for it, but you need to get that seller to come down. That's really what Eric's saying. Maybe we're missing something that they can point out and say, oh, hey, did you think about this? Oh, no, we didn't. But a lot of times we're just putting it back in the broker's lap and saying, hey, we're willing to pay this much. We think the owners kind of got unrealistic expectations. All right. Reading through the lines, that's what Eric is saying. And he's putting it in the broker's lap and saying, can you talk this guy down?
Well, one of the other things, and Brian's right, we did get this thing up to about 5.8 million on our offer. But one of the things just to keep in mind that I think is important is what this did by presenting it that way back to the broker is the broker actually said, Alex said to Brian, he was like, you know what? You're absolutely right. This guy doesn't have to sell. He wants to sell. And hey, Hutch, can you mute my buddy? I don't think you when you turned the car off, you came off mute. But he said, you're absolutely right. This thing is overpriced. This guy doesn't have to sell. He's trying to float a number and see if he can get it. But your underwriting is solid. I love the way you guys are underwriting properties. Let me show you a couple other things that we have that we haven't put out on the market yet. One of those happened to be Spartanburg. Another one happened to be a deal that we have under contract right now, and we'll open up for funding. We're doing due diligence on Monday. So we've gotten through this one deal. Not only did it bring us together as a team, but it actually has gotten us 3 other properties under contract through this group by showing, just kind of proving that we know what we're doing.
Yeah, and one thing that that the spreadsheet really helps us with is basically where we think investors are going to want to be. Okay, so the syndication model, we find properties, and then we also go out and find people who want to invest in real estate. Okay, ends up being a win-win deal. All right, but it really helps us to figure out, okay, if investors are expecting about a 15% annual return, you know, what's the highest we can pay and still reach that number? You know, so we go through all this effort, you know, basically to make sure that we're able to meet expectations of investors. At a lot of points in there, we're very conservative with what we do. You know, the renovation doesn't typically take 3 years. You know, for something this size, 18 to 24 months. But we plan our renovation numbers over 3 years. You know, in case something happens. You know, we have the Oh Crap Fund there. True story. The first week that we owned Spartanburg, an AC unit went down. You know, $6,000. You know, we had that Oh Crap Fund there. And it was, okay, well, there we go. That's why we had it. You know, we had a little replacement and reserve fund right there, and there we go. We're going to use it. But at the end of the day, you know, there's a partnership between that we have here that we're trying to make sure works on both ends. We want to be able to meet the investors' expectations, give them solid returns, and, you know, in turn, you know, we also do okay.
So at this point, we'll open it up to questions. Again, this was supposed to be intended for our first kind of how we underwrite things at a high level. Our next session in this series will be more focused on sharpening the pencil, taking what we know from property tours as well as property management's pro formas, sharpening the pencil and taking it to that next level. Any questions, concerns, thoughts?
My biggest thing with the with underwriting right now, well, I don't know, one of the pain points, I guess, is with the financing sometimes, where a deal looks good with certain terms and financing, like the, you know, interest only, not knowing what you're going to get at the actual, you know, close date is kind of like, okay, do I really go conservative? Do I not put in IO? Do I, you know, can we do like some sort of a refi supplemental? Because you can really like make it look good depending on the
Loan structure.
financing, right? And
Sure.
and you know, it's just that I've run into that where sometimes you can use the loan to cost, right? If you get that tab, put it to yes. If you can get financing for your budget, the deal looks awesome. And it's
Changes
like, oh.
everything.
And then, you know, but you may not get that, so you kind of go back to conservative. I'm just wondering now, because it is a competitive environment, do you try to get things a little tighter, like, or I don't know, go a little more aggressive now because what we're seeing, I don't know.
So we stress test. We try to be as accurate as possible with everything that we can check. You know, we can dial down on taxes, you know, and during the process, you know, once we start sharpening our pencil, we're calling an insurance company and we're getting a rough cut insurance number. So for the things that we can get down to the 1 decimal point, we're going to do that. But there's a lot of unknowns, and I think you hit the nail on the head. You know, we don't know, you know, with the loan application, we have a floating rate until about a week before closing, you know, so that's not controllable. So what we do is stress test it. Okay. So, you know, one step in the process is we're going to take this thing and we're going to say, okay, you know, rates today are at 4.75. What happens to our deal if they go up to 5.25? You know, what happens to our deal if they go up to 5.5? You know, how does that change things? How do we react? We do the same thing with vacancies. We do the same thing with rent as well. You know, if something really bad happens, you know, how much vacancy can we handle without losing our shirts? You know, and then as far as the lenders, you know, the lender is another one of your key partners. You know, so, you know, we're on the phone with the lender several times a week. You know, just going through, hey, so where are rates at today? How are we looking? You know, what's going on? But you know, if you were to pull my call history, you know, for the last several months. The after my wife and the Four Oaks guys, the lender's probably the next person on the list as far as who I've called the most. But
we talk to our lender anywhere between 3 and 5 times a week.
Yep.
Like
and,
literally, that's like we found, and I think we introduced you to him, Mark.
Yeah.
yeah.
We're big believers in what he does. We've seen his body of work. We've built a really strong relationship with him, and his word is gold to us. And so having that trust is a huge benefit. And that's what Michael Blanc talks about, or all these gurus, is how important it is to build a team. And Scott is a member of our team. He's the 5th Beatle. Don't tell John Fortes that; he'll fight us. But yeah, but you're right. Brian hit the nail on the head. Stress testing everything. But when you're underwriting on the front end, you've got to come into it. You've got to pay to play, right? So you've got to be aggressive enough on the front end to see what you can do with this in the best case scenario, and then also see with a realistic worst case scenario. I mean, some people get too crazy, in my opinion, with their stress tests of if I get down to 72% occupancy. I'm like, well, if you get down to 72% occupancy, something's happened the last 6 months that you took your eye off the ball. That's a big problem.
Yeah.
So as long as you're managing your managers the right way, you should be on top of these things, and you can help tighten your stress test to know really what's an authentic testing.
Yeah, I mean, 70% occupancy. If you're not, if you get down below 90 and you're not fixing it, that's on you, not the property.
Totally.
If you were to change this SDA to say, let's just say you can finance the reno.
Yeah.
Sometimes I do this. I'll say, okay, if I can get financing for the reno, this will work, or something like that. And I'll go to the lender with all the information, with the underwriting, and see if that's possible. I guess if there's enough debt coverage ratio, it's possible to do that. But I don't know if it's ever been, I don't know, have you seen it been used? Like, have you used that in one of your projects where we
did, yeah. Just recently.
We're actually on the one that we'll be closing on it probably first, second week of December. We're actually getting a larger loan than the purchase price. So purchase price is, $768. Our loan's going to be $876 because they're wrapping in financing as well. So
we got 75% of 75% LTC.
Yep, and it's more than the purchase price. So it does happen. And the one we closed last month, Spartanburg, and for everybody there, Mark's in on that deal as well with us. So is Hutch. I just lost my train of thought, but what were we talking about? Anyway,
the finance.
LTC. Yeah, we went in thinking we were going to get, a higher an LTC calculation, and we came out, with about between 70 and 75% LTV, based on where rates moved, and the lender has some very specific ways they calculate your debt service coverage ratio. All right. And they use the property's expenses, but they don't use they use the property's income, but they don't use the property's expenses, so you have no control over what they're pulling for their expenses. Anyway, long story short, we went in there thinking we'd get 75% LTC, and we came out with a little bit less than that, but based on LTV. So it does happen, and the way you fix that, you just stress test it. Early on, you say, what happens if, and what lever can I pull to make things still work? There's a lot of levers, that you can end up pulling. You can change structure. For the Spartanburg deal, for example, we went in at a 75-25 split. And when we lost proceeds, we changed to a 90-10 just to make sure that the investors didn't lose a dime. So there's still lots of levers you can pull, to stay in the deal.
Maintain integrity. Yeah.
Yep.
And one other thing to point out is, and I'm proud of this being our acquisitions guy, but between the last property we bought and the last 2 properties we put under contract, all of them have appraised at a combined collective $1 million over what we had them under contract for. So we have $1 million in instant equity by sticking to our guns, pushing our underwriting the right way, finding good properties and developing strong relationships. But what that does for us as far as building a cushion and starting things off with our investors on the right foot with the property, when you can come in and you have $300,000 to $400,000 of instant equity the day the property closes, I mean, that's a home run in home runs. You know, other folks are out there going, please God, let the appraisal come in and hit what I needed to hit at just to be able to get the financing to close. You know, we're on the opposite side. And so we're really proud of that. And I think a lot of that comes from the relationships we built by underwriting correctly, underwriting aggressively, conservatively, and communication with our brokers, regardless of whether we're interested in the deal, to let them know specifics of why this deal doesn't work for us and why we think this is a fair price, you know, with what we come in at. It's built tremendous rapport. Any other questions? I want to be respectful of everyone's time. We've kept everyone for over an hour.
Yeah, good. We're at the hour mark.
Well, guys, thank you so much for joining us. If you have any questions, please hit us up on a one-off, and we'll keep you posted on the next version of this, which will be coming up in the next. We'll probably wait until after the holidays, as crowded as it's going to be. And we've got a couple things that we're excited to share with you guys over the next week or two. So keep an eye out for some Four Oaks emails. But thank you guys for your time. Thank you for your support. Thank you for your commitments. And we look forward to talking soon. Have a great night.
Thanks, guys.
Thanks,
Take
guys.
care.